Hi everyone. This is Keith from Investment Modes. This Today we're gonna do something different. We're not gonna talk about the usual budgeting stuff that I used to talk about these few weeks. But just want to share some of my thoughts regarding an area of I think in investing that has come to my attention quite a fair bit. And I think it's because I think it's due to some of my readers reaching out to and they seem to struggle to try to make sense of areas in terms of investing to actually keep it simple, but also internally I've received some feedback that I think some of my colleagues they have a strong interest and motivation to actually find out more about asset allocations, right, after talking to some of their clients. And I thought that why not put something together to help them piece these things together. So I call this presentation crafting an ideal passive portfolio for your goals, which is something that I think a lot of people are interested in. And if you're interested in some investing solutions that tends to be more passive and scalable, then I felt that this presentation would be something that you'll find it useful. Okay. Now, before I start this, do note that nothing on this presentation is financial advice. I am licensed, but I am not your financial advisor, and so your situation is different. Each of your situations are different, and this presentation in a certain way is actually presented that way to give you some handles, because and that's one of the underlying message why I wanted to do this presentation itself. Okay, now let's go on with the presentation, but before that let me try to put a certain pen and then laser pointer. Okay, come, let's give it a try. Okay. Okay, so um, why it comes about is in a certain sense, like, I think we know that I think some of you all might not know, but to a lot of people who are in this space, murmurings out there, you would see kind of solutions like this. So this chart is a little bit busy, but in a certain sense, if people are familiar with, let's say, some of the financial institutions out there that is offering some cutting edge solutions, you have companies like, let's say, Endowus or MoneyOwl, who with their strategic portfolios. So these are portfolios that tends to be that has different kind of risk levels. As you can see, this is MoneyOwl, this is Endowus. So generally speaking, they have portfolios of different risk level. But I think people also struggle with how they should look at these portfolios itself. Yet on the right side of it, right, there are people who started out this, who comes from the perspective of they want to build wealth, and they ask around the social medias or different chat groups, and a lot of times either they are told to actually invest in the S&P 500 or an ETF that is S&P 500, or an MSCI World ETF, or MSCI All Country World ETF. So as you can see, this one is taken from our friends at Sidley, and it breaks down some of the exchange traded funds, which is listed unit trusts that you can purchase through a broker platform. So they are relatively cheap, and I think Sidley listed out what's the returns and standard deviation and all. But you can also see that I've cut and paste some of the topic starter that I see on Reddit, which is people asking, why is everyone talking about VWRA? Is VWRA still the choice for people who want to overweight segments like emerging markets? And why is VWRA becoming so prevalent? So if you're not aware of what is VWRA, VWRA is one of these ETFs over here. And to be fair, right, when we look at all these options, right, I think in general, I find that they're sound enough for people to accumulate wealth, but also to do their retirement planning or a lot of their financial planning needs. But in a certain sense, I think there is these things are simple, but they are not easy because they are so simple, right? There is a certain degree of things that you need to know about them. If not, right, halfway into it, right, you will have a lot of question marks in your head what you should do, and you suddenly find that these are not ideal investments for you. Now, on like when I say we're comfortable to recommend it, the place where I work with Provident, they'll probably have similar strategic portfolios as well. So while they most of them they look slightly different and all that, but I find that the underlying concepts are in terms of investment, right, are roughly the same. So they might not agree with everything that is actually presented today, but this is how I view how you should look at these kind of investments, because these investments, they are just strategic portfolios. They are ETFs itself. They are simple, but there are a lot of underlying things that you need to know of, and this is what today's presentation is about. Okay, so the first thing that you need to be aware of is that what are you investing for? A lot of people, they're just looking for investing, but they don't have a certain idea what are they investing for, and is this important or not? I think to a certain extent it is important to a certain because there is this some of these constraints, right? If you don't get it right, and some of these prevalent kind of unit trust or ETF solutions out there, they might not fit your needs. So in general, if we're thinking about what we're investing for, I think there are a couple of I would group them into two different groups, and probably a third one. So the first one is for those kind of goals that you're accumulating towards a financial goal. So imagine that you have a sum of money over here, and along the way you probably have some capital that comes from your work income and all. Your goal is that at the end of a certain period, we're not sure how long it is, you wish to build up a certain sum of money, and for this sum of money you're going to do something with it. So how long is this time horizon? We're not sure. Okay, so on the right side you can see some common kind of financial goal, right, that fits into this mode. Kids education, probably your kids is 10 years away. You want to make sure that they have enough money for their university education. You're probably saving up for furnishing, maybe 3 years away or 2 years away, very short term. Some goals are longer, which is your retirement fund, probably is like 15, 20 years away. And to a certain extent, some of you all might be thinking about leaving a legacy, like a sum of money that in the event, let's say you pass away, this amount of money can help equalize your estate. Meaning you say like one of your kids is going to operate a business, but other kids, what are you going to give him? And so this is this is what estate equalization. But when you look at these pictures, right, like you probably have mapped out this, you know what you want, you probably know the time horizon. Then the question is, how much is the return? Okay? And that is one of the topics what we want to find out today, because it's a very common questions for which when clients come in for holistic financial planning, we did everything for them, and the question is how much returns that you need. Now, the second kind of goal is that you have this sum of money already, and then you're thinking about spending down your wealth. So you can imagine that on a very periodic basis, you'll be withdrawing money. For those people that is retiring, probably they're gonna take out very consistently, periodically. Okay. The time duration is how long you want to sustain this spending down. Some maybe they're only expecting 10 or 15 years. That one probably is like providing income for kids and parents. You have enough money lah, so you want to provide some money for the allowance and all. But some you're maybe looking to for 25 years, because that's roughly how long you think that you'll live, from 65 years old till the end of life. So the same question is also like, how much return does your money need so that you won't run out of money too early? Okay, so largely speaking, the kind of goals that fits into this one is retirement, providing income for kids and parents, and perpetual income fund. Some of you prefer to have intergenerational wealth, and this will be something that fits over here. Okay, so roughly is this two: accumulating and spending down the wealth. Now, for some, right, I talked about this concept on my blog before, called your wealth machine, and I think for a fair bit of people, right, like especially for the singles one, they are not so experienced in life, and they do not know like what are they saving for. So if they do not know what they're saving for, then the automatic thing is to spend all your money lah. But I think most are prudent. Most of them are actually saving for the rainy day, which is why I think this concept called FIRE and financial independence resonate with them. But in a certain sense, I think what they're looking for is some sort of like financial security. So when I write about the wealth machine, it is trying to create a portfolios or kind of investment strategy, right? That you are the portfolio manager, okay? And probably you have to have the knowledge to actually like execute and monitor and then do all this rebalancing. But the general idea is you want to contribute regularly to it. You want to make the purchases. And over time, if that, let's say that you have a need, you have some cash flow that comes out that you can spend when you need it. So I think this concept, right, is basically not rocket science. It's marrying this together with this together with this. Okay. So, but the murky thing about this is that you're not sure what's the time horizon. Like you're not sure whether this one will happen in the next 5 years or 20 years or 25 years. So there is a certain characteristic of this one that you have to think about, which I'm not going to go through so much in this presentation over here. So maybe if you're interested, you can leave a comment to see whether you want me to do a more in-depth deep dive into this area. Okay? So depending on your goals, right, there are some things that you need to take note of when you are thinking about this and respect to what your portfolio actually need. So one of them is like roughly how much you need at the end of it. It's like if this is financial math, and if you're not sure about the financial math, you could consult someone who knows that. Usually it's financial advisors but I think you can figure out on your own. And how much you have at the start, what's the lump sum, and along the way on a regular basis, how much is your contribution. So with these two things, right, first and second things, right, it gives you a certain idea like, oh, okay, it's like what kind of rate of return that you're looking for. And I think it's very important to find out what's your time horizon. How long is your accumulation period and the period that you need to sustain this income, because this is one of the constraints that I think over the presentation you might be able to see it better. Now lastly is actually your risk capacity. In Provident, we call this your willingness to take risk. So the degree of fluctuation or volatility of your wealth that you can take, because not everyone can take this kind of volatility very well. Okay, so what can give you the highest reliable return passively? Now, the way that I phrase it is, I think, is a bit nuanced, because people can say simply, what stuff give you the highest return? But I think that in a certain sense, what most people are looking for, what is the highest reliable return passively, and not everything is passive, not everything is actually reliable. And I think the straightforward answer is equities. Equities have the most reliable with the longest track record backing it. And in a certain sense, to make it simple, right, there is so much talk about the VWRA, which is a Vanguard FTSE All World ETF, right? And in a certain sense, that ETF itself is like one ETF that allows you to invest 100% in a globally diversified portfolio of equities. So, but that is not, VWRA is not the only solution. You can invest in a unit trust or exchange traded funds that tracks a globally diversified index. So one globally diversified index that we are talking about is the MSCI All Country World IMI Index. So it is an index that I think MSCI came out with that tries to encompasses a lot of the equities in the world. So in total, there is like about 9,181 global companies currently. You can see the sector weightings over here. These are taken from the MSCI fact sheets. So fun fact is, if you Google that MSCI All Country World, you just type in this word, right, and then next to it you type PDF, right, it will give you a fact sheet like this. It is that simple. Okay, so this is the current weightings. You can see it's a very heavy in United States. And what's unique about this index is that it's 90% developed markets and 10% emerging markets. So these emerging markets are the countries that sort of like not stabilized yet, but they are growing into it. So they are the next potential ones that if they stabilize, they will become a developed markets. And so you can see the top constituents over here. Now it's not so hard to actually to invest for Singaporeans or international investors into this. So like what you need to do is you sign up for reliable, trusted, low-cost brokers. I think Interactive Brokers is a popular one. It is also happens to be the broker that I use. You just transfer money to a broker and purchase low-cost UCITS ETFs listed on the London Stock Exchange. Now, some of you might be having a question, hey, like I thought most of the most prevalent ones is actually ETFs listed in Singapore or United States. So Keith, why do everyone focus on what UCITS ETF on the London Stock Exchange? I think there is some tax considerations there. And I think I wouldn't go too deep into this this part of the discussion. But if you're interested, do leave a comment to see whether like I can make a video to actually explain this. So if you realize like most of the platforms, MoneyOwl, Endowus, probably at Provident, and myself, we are all using UCITS ETFs, these Irish domicile ETF. So that lets you know something about like what is some of our consideration when we think about this. So you fund and purchase in lump sum or regularly with your paychecks. So this is I won't go into any recommendations, but if you're interested and all right, these are some of the ETFs that fits this space. So they kind of covers this MSCI All Country World IMI kind of situation, where most of them they cover developed emerging markets, but they also cover the larger companies, mid cap companies, as well as small cap companies. Except probably the last one, BlackRock shares MSCI ACWI. So IMI actually stands for the coverage for not just the large companies, but the mid cap and the smaller companies. So these are the ticker symbols. You can Google VWRA ETF, IMID ETF, and you should be able to get some of the fact sheets. And these are some of the expense ratio. So expense ratios are like part of the most of the costs of this ETF, and as you can see, it's very low compared for Singapore investors who remember that a lot of actively managed unit trusts out there. For a long while, their expense ratio have been about 1.5 to even 2%. So this is like kind of low. Okay, so with why we invest in equities versus cash is that this is a growth of wealth chart. Like we're taking the MSCI All Country World IMI Index, and we start off with the data that we have, which is since 1994 and to today, June 2003. And you can, this charts, like if you put $1 million in the MSCI All Country World and 1 million in 1 month US Treasury. 1 month US Treasury means it's like very short-term Treasury bills that is almost like cash. Is 1 month. It's like you should have very adequate liquidity. So during this period, right, the compounded average growth for the MSCI World MI is like 7.1% per year. The 1 month Treasury bills is 2.2%. So if you have $1 million, right, you can see that at the end of this period, which is like about 28.5 years, probably around a time that people accumulate for their retirement, and you can see 1 million becomes 7.36 million. But of course, we know like not everyone have 1 million at the start. But I can put $1, but I think 1 million is more impactful. And if you look at it as 7.36 million, you'll be like, wow, that's like about 7 times. And for 1 month Treasury bills is like 1 million becomes 1.9 million. It is low, but you can see the journey is different. This one is like kind of flat. Okay. Now, the next question is, what kind of returns can I potentially get if I invest in a broadly diversified equities? This is probably the questions that is on a lot of people's mind. Sorry, let me take a sip of this kopi siu dai. Kopi peng siu dai, which is very, very bad. It's like kind of regretted buying this, but I think I need this one for such a presentation. Okay, so what kind of returns that we can get? I think firstly, the returns that you're gonna get going is future returns. Past performance does not indicate what the future will entails, but history will give us a glimpse of our future potential returns. And as you can see over here, this is a chart of the Dow Jones Industrial Average from 1896 to 2016. That's like probably about 120 years, if my math is not wrong, 119 or 120 years. And you can have a lot of reservations. Would equities work in this kind of scenario, or would it not work in this kind of scenario? But as you can see, which is a bit blur on this chart right now, from this period to this period, there is a lot of things happening. Like there's a lot of turmoils and all that. If you're interested, you can just pause the video, do a screenshot, and then you can take a look all the different kind of stuff that happens. We human beings are very myopic. We cannot remember. We can as a person that is trying to recollect, we cannot recollect so much. So we are quite myopic to think that actually not a lot of things happen during bull markets, and only a lot of bad things happen in the bear markets. But that is not really the case. If you look at this one, it's a whole bunch of things. But in a certain sense, because we have so long of history, we can have an idea how returns are going to be like. Now, before I go on to talk about the returns, the first thing that I want to explain is this concept called rolling returns. And if you're familiar with my work, right, you see a lot of like thing about rolling returns. But what is actually rolling returns? Now, imagine that this is a chart about MSCI World Index. I decided to use this index because it's about 53.5 years. It's a long duration. Okay, it's a long duration, and you can see that. Definitely, this is a chart that shows that you're making like if you hold it for 53.5 years, you're gonna make money. Okay, But the question is, a lot of people say, I don't have such a long time horizon every time. And so the question is, if I live through a period like the past X years, what kind of annualized returns will I experience? So maybe your time horizon is only 15 years. Like you're looking for 15 years. So the question is, within this 15 years time frame, right? Like what kind of returns you're gonna get? But because we have this history over here, right? Like you are able to see what kind of see the kind of range of outcomes that can happen. So if we talk about 15 years, right, the first 15 years might start from January 1970 to let's say December 1984. That's one 15 years period. And you'll probably be able to get what's the annualized return for this 15 years period. An annualized return will give you a certain sensing of like what are the returns that you're going to get to actually put into the financial calculator for your financial goals itself. Now, after that, once you find out the returns for this one, you can go on. Okay, now we go to maybe 1971 to 1985. That's another 15 years period. And then you go on 1972 to 1986. So these are rolling returns. You'll be able to find out the returns for all of these periods. Okay, so why are we interested into all these 15 years periods? Because again, this history has a lot of these kind of information out there. They have different kind of inflation periods, different interest rate periods, and the result of this is this return over here. And what you want to find out is that, there are periods that is like bullish, there are periods that are bearish, but roughly, if my time frame is 15 years, right, what kind of returns roughly would I be actually getting? Now you can replace this 15 years with 5 years, 3 years, or 2 years, and you will have a different kind of range of result over here. So we have, like in these examples, over 1970 to 2023, we have like about 463 15-year periods. So we are able to find out with all these kind of like different kind of market conditions, roughly if we live through a period that is similar to one of the 15 periods in the past, how would it look like? Okay, now let's go on to look at the actual returns itself. So the first one is that if let's say we look at a 1 year period, okay, 1 year period of let's say the MSCI World. I'm using MSCI World. It's different from MSCI All Country World because it's only focusing on the developed markets. It includes US, but also developed international markets. Doesn't include the emerging markets. But in a certain sense, right, I think what I want to show over here is kind of reflective. The returns are not going to be exactly similar, but it should tell roughly what I want to tell. So within this period of 1970 to June 2023, right, which is 53.5 years, we probably have about 631 1 year periods. So I am rolling this month by month, which means that let's say I'm starting from Jan 1970 to December 1970. Then it's February 1970 to to January 1971, so on and so forth. So while this is only 53 years, we can have like about 631 1 year periods itself. And if we plot out the range of 1 year returns, right, we are going to have a distribution like this. We consider this as different buckets. So at the bottom, you can see like the range of returns. Like this one is started is minus 47.1% to minus 39%. So there is going to be 6 periods in the past where the returns is going to be this negative. Probably this one is also very negative. But you can see that the median returns is like about 12.1%. This is, I think, before fees itself. And there's like about 124 instances. But this thing gives you a certain sense that although we might use, let's say, 10% per annum to do our planning, your actual, when you live through this one, your actual your returns, right, it'll be one of these. Okay, it's likely to be one of these. It can be over here, can be over here, can be over here. We're not sure. It's uncertain. Okay, so this is like 1 year. Now let's expand it on, if let's say we talk about 5 years. Now you can see 5 years, right? The difference between 5 years and 1 year is that, oh, the returns are, these are annualized returns. Okay, this, which means that it's like, if we talk about, let's say 6.4%, you can imagine that for the 5 years, each year is like compounded at 6.4%, 6.4%, 6.4%, 6.4%, 6.4%. But of course, there is also the negative one where it's compounding at minus 5.7%, minus 5.7%, minus 5.7%, minus 5.7%, minus 5.7%. But of course, there can be the crazy ones where it's compounding at 27.6%, 27.6%, 27.6%, 27.6%, 27.6%. So it's a bit of Jekyll and Hyde within a 5-year period. So what this shows is that it is still a spectrum of returns, and 5 years is still short enough that you can experience negative returns. Now let's go on. This is 10-year period, and you can see everything getting smaller and smaller already. You still have negative returns. From this 53-year periods, there's going to be 10-year periods where returns are negative. Okay, this is something to take note of. Now let's move on to 15 years. Okay, for those who find that this is too fast, you can pause the video and then take a snapshot of this one, or slowly digest what I've actually presented. Now you can see at the 15 years, right, almost all the returns are positive already. So if you look at the progression, it started off with part negative, part positive, less negative, and then now it's positive and all. So there is, what we say is that there's empirical evidence that if your time horizon is long enough, you get positive returns. But the question is like, how long is long? And that's a question for another day. So you can see it is still, even though it's positive 15 years, it is still a spectrum of returns. The median return is like about 8.5%. It falls somewhere closer to this one. But you can see that even though it's 8.5%, there are 15-year period where you're going to get 2.8% per year only. There's also a 15-year period where you're going to get like about 16% a year. It is still uncertain. It is still a range. Okay. Now this is 20 years. Now you can start seeing that, okay, it's almost the same, 3.2% at the lowest. But if you ask me like how long probably you need in order for it to be a decent, let's say 5 to 6% return, and my answer is, the data shows you probably need like about 25 years. Okay, as you can see, like majority of it falls between 5.5 to about 15%. The median is still about 9.2. You see, 9.1, 9.2 for the median, not too different, but the range of returns now is actually smaller. So what this kind of means is that actually equities is like there's a certain volatility to it. There's a certain time horizon that you need. So with this in mind, right, like your time horizon is, let's say, 25 years if you're accumulating towards retirement, you can have a more reasonable gauge, like what is the returns that you will use for your planning. So in this sense, because if you look at this one, it's like the median is 9.2%, you might want to use something like 9.2%. Personally, I feel it's a bit optimistic lah, but if you look at, based on my data, that's probably something that that you can put. And on a planning basis, you can see, oh, you can work towards 2.2 million. Is 2.2 million enough for what you want to do? In this case, is retirement. We're not sure. Okay, that's the part about the financial planning that you need to figure it out, that we won't go through too much today. Okay, but one thing to keep in mind is that while we use 9.2, there's a range of return. 5.5% versus 9.2%. is a lot of money. 9.2% versus 13%, it's a lot of money difference. Okay. Now, if I say that I think equities give you the highest return, and broadly diversified equities, right, is so good, right? Then why do we consider other kind of allocations other than that? Why do we add this, add that into it? Now, the first thing is that your time horizon may not be long enough. Some of your goals, right, might be 5 years. And if you take a look at the right side, which is the same table that I have, which is a 5 years rolling returns, right, for the MSCI index, you can see that you have these periods where you invest for 5 years and the returns are negative, which means that you went through a period that is where the market conditions is just not favorable. Okay. So you imagine that you need the money within this period, right? And by the end of these 5 years, the returns are negative and you don't have the sum to do what you want. So this means that you can't put everything into equities. Like you can start off without any idea, you invest in this thing called VWRA, right? But that might not always be the prudent thing. And sometimes when you understand like what is your goal, you're able to define your goal better. What's the time horizon, right? You might need to actually reallocate your resources. Okay. Now the other thing is that not everyone can endure the volatility. Now what you're seeing over here, right, is a drawdown from peak chart of a 100% equity portfolio. Okay, I won't tell you what is the portfolio itself. It's an internal index that I use at work. I just want to make it simple, so I repurpose it here. So you can see on this chart, right, that this is from 2001 to 2021. That's like about a 20-year period. Within this period, if you hold equity portfolios, right, like this one, you will show like what are some of the degree of the drawdown or the fall from market peak. So you can see that, let's say it was here and then it falls. Okay, this and then it falls. So how much is this fall? Okay, and this is it lah. Okay, so you'll be able to see that there are falls that is like minus 22%, minus 56%, minus 14.5%, minus 16%. Some of you feel might be able to take it. Some might not be able to take it. I don't know. To me, is that sometimes I feel it's the magnitude of the money that you have and how close you are to your financial goals. So some people who is like near the end, you can imagine 60 years old, you put like all your net wealth, $3 million into it, and then it fell 22%. That's probably like about 600k of your hard-earned money going down. What will you be thinking? So I think there's a reason why some of us cannot deal with this kind of thing lah. I am, for one, am humble enough to actually admit that I don't take volatility that well. So this is an area that sometimes I think about as well. And it's whether you have the kind of humility to actually admit some things like that. But I think over time you'll be able to find your risk tolerance, like how much you can actually take. So enter bonds. Bonds are different from equities, and bonds for those that is uninitiated are debt instruments that you can buy. So basically it is companies, right? Let's say for example Amazon, right? They need money as for their business, so they issue these kind of bonds or fixed income instruments, and you give them your money. In return, on a periodic basis, they have an obligation to pay you coupons, okay, which are interest. And at the end of the period, right, they are supposed to return you the principal. So it's basically like IOU lah, but it's corporate IOUs or government IOUs. So the nature of bonds is that why it makes sense to add to your portfolio is that bonds have much lower volatility. Now this is what you see over here is a chart of the range of. It's also a rolling return, but it's a rolling return of 100% portfolio in 5-year US Treasury bond index. And US Treasury bonds are US government bonds of an average maturity of 5 years. So it's a portfolio that is diversified. It contains 100% in government bonds, and government bonds, to a certain extent, U.S. government bonds that they have very high credit rating. So to a certain sense, I think in the financial world, we all treat them as actually risk-free instruments, and we have quite a fair bit of data from 1926 to June 2023. That's like about 96.5 years of, let's say, a rolling 5-year return period. So that's like about 1,111 5-year periods. So you can see the range of returns if, let's say, you invest in these treasury bonds and then you keep it for 5 years. Now, 5 years, remember that equities 5 years, you can still have periods where it's negative returns. I'm not going to say that if you keep these kind of 5-year US Treasury bonds, you won't get negative returns. You can still get it over here. So the actual amount of these periods where you can get negative returns is probably 2 out of 1,111. And for those who are curious, those negative minus 0.2% for 5 years, right? That returns, right, is recently when the bond interest rate went up like about 400%. Okay, but in a certain sense, even let's say if you talk about these periods, right, if your time horizon is 5 years, right, investing in bonds, right, it allows you to have higher certainty that you are able to get your money to actually do what you wish to. But as you can see over here, there's also a range of returns. You can have 5-year periods where the returns is like about 15% a year. That is possible. It's not just low returns. But on the medium term, I think for 5-year treasury, it's like about 4.5%. But generally speaking, I think a large part of the bond returns, if we're talking about 5 years, right, large part of it depends on what's the average yield to maturity and all. That's a topic for another day. So what happens if you add bonds to your portfolio? Now, over here you can see that there is two bar charts over here. The top bar chart is a portfolio, the returns of a portfolio that is 100% stocks. The bottom is a portfolio that is 60% stocks but 40% bonds. Now, over this period from 1973 to 2021, right, probably a long enough period, you can see that majority of the times 100% equity portfolio is like it's blue in color, which means that it's positive. But there are these periods that can be quite challenging for some people with a lower risk profile. You can see this is minus 15%, minus 25%, minus 13%, 17%. This is 3 years of these very poor returns, and this is minus 41%. Now, if you add 40% bonds into it, this is what happens. You can see this minus 15% and minus 25%, it becomes minus 8% and minus 12%. And over here, minus 13, 17, 20 becomes 4, 7, and 8. So if, let's say, your portfolio is larger, say it's like about, you're coming to the end of your accumulation periods and it's like about $3 to $4 million, right? It might be much more comfortable if, let's say, you have the bonds inside your portfolio, because visually you'll be able to see, you're not losing so much money and all, and this might allow you to stay in the game better, because while this one earns you a lot of returns, right, but you might freak out so much that you might not be able to harvest the returns in the long run. Now, if we have stocks and then we add bonds to the portfolios, right, you can imagine that we can have different allocation of equities and bonds. So over here you can see 6 of these, right? Something similar to the strategic portfolios that we see at the start of MoneyOwl, Endowus, and probably Provident, right? You can see that there's 100% equities, 0% bonds, 80% equities, 20% bonds. And I'm taking the data from an MSCI World Index as well as a 5 years US Treasury you can see on a 10 years annualized basis, right? This is the range of returns. It's always a range. It's not fixed, and you can see that there's this best return, and then these are the worst returns. As you add more bonds to the portfolios, the worst 10 years returns, right? It becomes positive, and all. So depending on your time horizons, right, you can have different portfolios, different kind of portfolios. So the equity heavy one is more aggressive. The bond heavy ones is more for people who are more risk averse, but also when their time horizon is shorter and longer time horizon. So this is some handles that you can have when you're planning for your financial goals. Now, the question is that Keith, how are you so certain about the returns itself? Now, I'm not so certain about the returns because you can see there's a range of returns, okay? But in a certain sense, the questions to ask when you're asking this is like, why are you so certain about this versus other investments vehicles out there? And for this part, it is something for you to think about when you're evaluating what is the financial securities or the investment vehicles that you use to build your wealth towards your financial goals. What to think about. And I think people want a kind of certainty, but a lot of times they don't know how to actually think around this thing about certainty and all that. So when it comes to talking about how sure are you about investments, right? There are two things for you to consider seriously. This is part of, I think, our Providence investment philosophy. There's about 4 pillars, but I think I'm going to pick out two of them because these two are more relevant, okay? These are the two things you need to be sure about if your money is important to you. Your money is important to you. If let's say your money is not important to you, you don't have to consider these things so much, okay? The first things are, what are the economic drivers of return, okay? And the second thing is that, are there any empirical evidence that what we say in one is true? So basically, it's like whether number one is actually back up together or not. And you have to view these two things together, okay? Like what are the drivers of return and whether there's any evidence, okay? So in a certain sense, what drives investment returns? To me, right, what we're doing, right, is we are taking risks and hope that we are adequately compensated for taking risks. Okay, so basically we're trying to take risks. Everyone would say in order to have returns, right, you have to invest, and there is always risk and return to investment. So the way that I'll explain it, right, is that what drives returns, right, is there's a lot of uncertainty involved, and you're taking risks by taking on this uncertainty and all, and you're hoping to get compensated for taking the risk. So if you look at this diagram over here, if you take risks, right, there can be two outcomes. Either you get compensated or not compensated. Not compensated is lose money over a certain time frame, be it a longer term time frame or shorter term time frame. If you're compensated, right, you earn a premium. We say that you earn a premium, okay? This is because like there's empirical evidence that shows that, hey, you take this kind of risk, you're able to earn this return, and then you're able to earn a premium. But it's not always the case. We sometimes we take risks that is not rewarded. Some of you might understand that. And for a risk that you take that is rewarded, there is a premium. For a risk that you're taking they are not rewarded, there's a negative premiums. So the returns that you get is the reward at the end of the tunnel for bearing risk. So when we invest in equity and bonds, right, we're taking risk lah. If you're an equity holder, right, although you're holding like 9,000 companies for the MSCI All Country World, right, you're holding a equity ownership in a lot of these like so-called lemonade stands, but they're not selling lemonade. Lemonade is, I think, the ideas that most people are the most familiar with. And you take on the risk of business failure, like this company called PayPal, right? You can collapse, or Coinbase, right? Coinbase is in the news right now because of a lot of SEC uncertainty over there. They might not be able to operate soon. So those sort of things. So these are uncertainty. These are risks that you take on. Like it might work out or it might not work out. These are uncertainty. And because you take on this uncertainty, you might be rewarded. So the income and cash flow projections might fail to materialize. Okay. Now, if you take your borrowing, right, there is also risk involved. There is risk that the person that is lending you the money will default. Okay. You're taking on interest rate risk, which means that you're lending out the money at 2% a year. But right now, people are lending out at 5% a year. There's opportunity cost. You're losing that opportunity cost. And if you lend money out in USD or SGD, there are also differences over here. So there is this uncertainty and all that, and there's a reward at the end. So when you invest in equities and bonds, there is these fundamental reasons, fundamental things that underpins this one. In Chinese we call 这个不是假的啦, like 这个不是没有 risk 的, and there's a certain reasons behind it. So what you don't want, right, is that if you don't consider the returns, right, you will have situations like this. These are two illustrations, right? Like if you plot out the S&P 500 and let's say the butter in Bangladesh, the prices, right, you can see that when R square equal to 0.75, which is if it's closer to 1, right, it means that they have a close correlation. But can you infer that now that you know the price of the trends, butter price in Bangladesh, right, it can predict the price of S&P 500? This is a bit far-fetched, but most likely you all would think not. Here is another example. If let's say you slap together butter production in Bangladesh and United States cheese production, sheep population and all, you will get a R square of 0.99, which is like very predictable. But what does that mean? Like is this? Can you use this one to predict the price of the S&P 500? I think there are a lot of things like this, and if you don't think about the drivers of returns, right, and you don't think about what's the fundamental behind it, whether you're taking on risk and then whether there's uncertainty, there's a lot of people will actually fall for scams due to these reasons, because they haven't considered like these things called, let's say, Geneva gold, right? Whether actually is it possible that while it's holding gold, they are able to give you cash flow? Like, is that possible at all? How do they do it? So this is one area of consideration. Okay. Now the second thing is that we say that about the economic drivers and all, right, but why are we so confident about it? So how do we know that our risk taking is actually rewarded? So basically is that we need enough empirical evidence. Empirical evidence is a big word for numbers. You need numbers that show that you're rewarded for this risk taking. So as you can see over here, over that period, I show that over different time periods, like this is like about 53 years of periods, right? Where whether it's 15 years or 25 years or 5 years, right? You can have you can earn this range of returns, whether it's right or not right. You are able to have empirical evidence to roughly let you make sense of it. Okay, so so these are two things for you to think about. If let's say you want to invest in this investment vehicle, let's say private notes, right? Let's say your company, your friend has this private they let you in on this like private equity deal, right? There is this short-term notes, right? Think about these two things. What is the fundamental drivers, and then whether there's any numbers that substantiate this kind of investing, and this might allow you to avoid some troubles over here. Okay, now with this in mind, right, you can look at your portfolio in a different way, and this is how I look at a portfolios, and probably this might be a bit different from how some of you think about it. Okay, so essentially, when you own a diversified portfolio, most people look from the returns angle, but basically what you want to own, right, is a portfolio of diversified risk that you will be rewarded reliability. So what most people's portfolio should look like is something like this. You can see that it's a pie chart of, let's say, different kind of investments. Could be equities, could be bonds, could be property, and could be cash. The questions to ask is that whether all these risks are actually compensated. Compensated means that whether you're rewarded. So if money is important to you, right, your portfolio should be something like this. It's a portfolio of compensated risk. Now what happens for a lot of people, right, is something like what is on the right side. They probably have a lot of cash, okay? They probably have a lot of properties, but I'm not putting it over here. But in a certain sense, right, they are not sure like whether the investment that they put in, right, whether they will earn a return or not. And then the kind of questions that they will ask is that but I'm not sure, like the story seems to sound good. The story seems to sound good, but I am not sure whether not say they won't say I will not sure. They say I have a feeling that the returns will be good, but they have no ways of actually substantiate it, or they didn't do deep enough work. So in a sense, a large part of this one is uncompensated risk. And because they don't do so much work, right, they end up with a lot of small slices of these uncompensated risk, right, because they don't dare to put in a lot of their money. And this is usually like what happens. So in a sense, if your money is actually important to you, right, you should move into something closer to something like this, which is that a portfolio where there is sound economic drivers, and there's empirical evidence that shows that taking risks, you would be adequately rewarded. Okay, so what happens is that this is likened to actually owning a volatile savings account with a constrained time horizon with less than certain returns. So I'm probably going to get some flack for saying that this is a savings account, because this is not a savings account, but the framing is something like a savings account or an endowment plan that has a certain long horizon, right? Along the way, you're gonna get a lot of like volatility up and down, up and down, up and down, right? And you're investing in a portfolio where you're taking risks but diversified, and in a certain sense, we're not sure like what's the return that you will have. Because over here, you can see that if it's on a shorter term basis, it's a range of return. Even on a 25 years basis, that is also a wide range of return. So what you're doing is that you're trusting the markets, right? That you're trusting the research, the empirical evidence behind it, in a sense that there's fundamental reasons that you're taking risks, you're doing the appropriate things to be diversified enough to not take on some risks, and then you're trusting the markets to try to give you a certain returns that you need for your financial goals. Okay, now you are delegate when you're investing in funds, unit trusts, strategic portfolios, or ETFs like this, right? What you're trying to do, right, is that you can see for some people who stock picks, or they treat themselves as a portfolio manager, you'll be something on the left side, where you are trying to where you're trying to have your own style and strategy, execute and monitor, and then rebalance yourself. And you're doing a lot of buying and selling of this. Whereas to be more passive, right, your wealth machine will be delegated in such a way that you have a few funds, not too many funds, but the funds itself will do the execution and the rebalancing, a large part of it. It doesn't mean that you won't do any execution and monitoring. You'll probably be thinking about the fund allocation and the rebalancing, but a large part of the work is actually like delegated away. Now, but you say that, hey, Keith, I am afraid of taking risks. Wait, give me a second. Wow, the coffee is getting more diluted. I miss the coffee at our office. Okay, so you say that, hey, Keith, I am afraid of taking risks, especially when you look at this chart. They say the way to view it is that there's a lot of risk involved, and you're not very comfortable with risk. I can understand that lah. Okay, and what I can say is that then you cannot earn that returns. Okay, almost all investments out there, if let's say the returns are higher, right, they have some kind of risk. Small risk, big risk, different facets of risk. There are some risks there. Okay, many think that some of investments are not risky, but only realize later that they are not reviewing the investments the right way. And people gravitate towards things that looks. You hear the sales pitch, right? Like the person would mitigate by not telling you so much details about these investments, right? And if you know some of these details, then you realize that there are risks involved. But it's presented in such a way that is abstract this part away from you. And this is one of the reasons why I felt that many risk-averse investors, right, they eventually fall for a lot of these scams or very poor investors, because the salesperson know this weakness that, hey, I cannot take volatility, like I want something with sure returns and all that. So the sales pitch is put in such a way, right, that masks away a lot of these things. Okay, they will have enough for compliance reasons, right, that they will not fall short for bank compliance reasons or financial institutions compliance reasons. But in a certain way, because they don't say, if they say out some of these things, right, you will have reservations about this, and then you won't invest anymore. And a lot of risk-averse investors, right, they fall prey to something like that. So the way that they look at this one is that this thing is not risky, and then they invest in it. Then later on, they have a bad surprise. Now, what's less said about this kind of diversified portfolio is that they take care of, while I say compensated risk, you're taking risk, right? There are some risks out there, right, that you might be afraid of, right? And these portfolios, they alleviate for you, but they're not telling you in a certain way that I am going to say it. Okay, so a low-cost diversified portfolio alleviates a few of your big fears. Not all the risks, but some of these fears that you might be concerned about. So let's go through them. So some of you might be worried, right? What if a big company blows up? This is very common. It's like I've seen people with very concentrated local portfolios, right? And then a thing on their brain, constantly they will be thinking. It's like constantly they will be thinking. They will say, okay lah, I hold these few blue chips, right? They should be okay lah. An in Chinese means let's don't have to worry about it so much, that it should be okay one. Okay, but whenever there's a fall, right, they tend to be kind of worried about it. And the nice thing about this portfolio is that what we know is that these big companies, they don't blow up overnight. Sometimes they become smaller and smaller. So over here in this chart over here, right, you can see the top constituents of the largest companies in the world, right? From the 1930s to the 2020. This is courtesy of Dimensional. So you can see the top companies, they change over time. Like the longest one probably is General Electric. You can see is this. You follow my cursor. It's like quite long and all that, and then it disappears. From 2010, it disappears. So while you can have an individual company that is very strong, right? Like nothing lasts forever. It's like my colleague Isaac, one of his favorite like philosophy about when you look at this market is about not all these individual companies, right? Eventually, it's going to die. Okay, that's a thinking. Not too wrong, but we have to like flush that out better. And so companies don't blow up overnight, but they will become smaller and smaller. Okay, but your portfolio is so diversified, right, that one of these companies, right, they won't impair you. So you imagine if you have 10 of these companies and you hold, let's say, $3 million, right? Each is like 300K, right? Usually what happens is that this company becomes smaller and smaller. But we will talk about some of the mental things later on. But it's not going to be such a pleasant experience if you live through this one. Companies weaken and stronger companies take its place. So you can see that while some of these companies become smaller, like these four is not around anymore, they probably consolidated. Over time, some other new companies, they come about, okay? And this is the nature of this portfolio. And what I say is that your portfolio has a auto self-rejuvenation mechanism. They have this way of actually like survival of the fittest, okay? You might have some worry about certain sectors, like is very concentrated in this sector. So in this chart in this illustration over here is from MSCI. You can see the components of the MSCI. This is, I think this one should be the MSCI investable, all country world investable market index, right? IMI index, right? 201012, right? The sector allocation is like that. Large part is in financials. This is in 2022, okay? Some of these sectors are roughly the same, like consumer discretionary and all is like still 11%, but you look at the consumer staples, now it's 9%, it was 9%, now it's 6.6%, okay? Information technology, it was 13%, now it's 21%. So the stronger sectors will grow into it. And again, I say this is a self-rejuvenation mechanism. These things also take place over time. It's not going to be like a one-time shock point like this. This is what everyone is thinking. Like, oh, suddenly this sector is going to be severely impacted and then they're going to die like that. No, normally it's not like it's a gradual change in some of these things. Okay. I'm worried of a particular country region. And the idea is that if you're diversified enough, right, you have less of a FOMO. Diversify means that you have less FOMO and you can capture the returns when it's least expected. So on the left side, what you see over here is from, it's not actually exactly an index, but actually a 22 country world equity index from 1900 to 2012. You can see the change in allocation. Like the US used to be very small, less than 25%. Now it's like closer to 50%. But you can see at a certain point in the 1990s, it's also nearly about 25%. That's when Japan became so big. So you can see that index itself, right, it takes in all of these things. And I like to say that if you have a diversified portfolios, right, let's say you have a country that suddenly appears like Wakanda, that no one knows that they have such a strong technological portion to it. And then once they get some of these companies that they get listed, right, if you're in the S&P 500 alone, right, you think and all, right, you might miss out on that. But honestly, I think if let's say Wakanda all the companies come into play, most likely they'll also be listed on the US stock exchange. So there's not going to be any difference. But I think there's some humility involved to actually be globally diversified. And over here on the right side, you can see that in terms of MSCI EFI and MSCI US, EFI stands for the Europe and Australia and a lot of Far East countries that are more developed. Together, is considered as this MSCI EFI index. You can see the difference in outperformance of this EFI and USA over from 1971 to 2021. it takes place. It's not always that the US have this outperformance. There are some years where this ETFs is outperforming, and while it's good to actually look at this one and say that you are able to live through this period. But I can tell you, the experiencing person, right, when you experience some of these underperformance, right, is not so comfortable. So the solution to this one is try to be more balanced, to actually own everything. Okay, now diversification, most people look at it as risk management, but essentially what is seldom talked about is also diversification is also about capturing returns, and it's about FOMO prevention in a certain way. Now this illustration comes from Dimensional. It's their research of the global stock performance of if, let's say, we include and exclude the top performers. Okay, so the underlying message is a small number of stocks drives the returns of a low-cost diversified portfolios. So as you can see, if we include everything in the index, right, the returns are about 7.2%, 7.2% a year. Now, if you remove the top 10% performers each year, not the top 10 biggest company, the top 10 performers, right, your returns drop to 2.9% if you buy and hold. Okay, if you leave them out. If you exclude the top 25% of the performance, right, your returns go negative. Okay, now this shows if you're holding these strategic portfolios and missing out on some of these companies, right, they dramatically will vary your returns. Now, it's also important to note that you won't be able to know who are these top performers until in hindsight. Like those people in 2000, would you know that actually from 2000 to 2010, one of the top performing stock is Monster.com, Monster, the drink itself, the kind of like very sugary drink itself. And it's only when you come to 2012, right, then you realize that, oh, Monster is a big performer. Okay, just like maybe EMC is a big performer probably after the .com period itself. Now, this is another illustration. It shows this is from JP Morgan itself, is to illustrate that the Russell 3000 index, right, is a index about US larger and smaller companies. So it's a combination of their larger companies and smaller companies, right? If we add all the companies together and then we try to tabulate, let's say, what is their excess lifetime returns on these individual companies, right, you'll see that the median is over here, right? The median is negative 10%. So the median individual stocks will experience a negative excess lifetime returns. Okay, this goes a bit to like what my colleague Isaac likes to say about like all these companies are destined to die one of these days. Die can mean that they're being acquired or those sort of stuff. And what happens is that, why is this Russell 3000 index, right? You see the same spectrum of returns, but if you hold for 20-25 years, right, it should be positive most of the time. So if let's say the median returns are like negative 10%, then how come the returns are positive? So basically, a large part of the returns is driven by the small number of stocks over here. Okay, it's driven by this small number of stocks, and it's easy to underperform the index through stock picking because you're playing in this round. You're trying to pick within this round, and there's a bit of portfolio management or buying, selling, and holding that you need to think about. Okay, now diversification is also having a humility to actually accept that you do not know everything. Okay, so I put this two chart over here. It is a tabulation of an MSCI World Index. If you invest, let's say $1 million in the MSCI World Index, $1 million in the 100% MSCI Emerging Market Index, and the diversified portfolios, right? This is made out of 90% MSCI World, 10% Emerging Markets. Okay, there's these two different time periods. This is 1999 to 2009. This is 2010 to 2019. What you'll notice is that the growth of wealth, right, there is extreme difference. $1 million in over here at the start grows to $4.2 million at the end for emerging markets. But for the MSCI World, which includes US and all, right, it only grows to $1.2 million. Okay, not very good returns. But if you have a diversified portfolios, right, your returns are slightly better. It's not as fantastic as this one. It depends on what's your allocation itself. And in a certain sense, instead of FOMO, right, that small amount of allocations, right, would allow you to actually like be able to live with this kind of FOMO better. Because if we fast forward to look at the next decade, right, 2010 to 2019, you see the opposite of this, that the MSCI World Index, right, $1 million becomes 2.47 million, but the emerging market, $1 million becomes 1.44 million. It's totally different. And the question is like, at the start of this one, right, where, if you look at the results over here, right, where would you normally put your money? Will you put your money inside MSCI World or emerging markets? My bet is that most of you'll put inside the emerging markets, and you'll end up with performance like this. Okay? Now, we do not know what's going to happen for the next decade. So, by having a diversified portfolio, it's also leaving enough buffer for errors. It is also an admittance that we'll only know a lot of these things in the hindsight itself, that we are not all seeing, that we really don't trust our forecasting skills enough to bet to bet our money on this. Now, if you have a different philosophy to this one, right, that's where you will have variations of this. Okay, so the best cure I find that for FOMO, right, because when you're living with this one, right, when you're living with your investments, a lot of people will be asking questions. Should I be investing in smaller companies? Should, like, even if let's say you made your money already, all your money in bonds, you'll be asking your advisor, what do you think about equities at this moment? Okay, like they'll be asking, like, when emerging markets, let's say they start to run already, then they will be asking, hey, is our emerging markets allocation too small or not? I say, or should I focus all on information technology? Why investing in this diversified portfolio is simple but not always easy is because you're always going to have a lot of these kind of like thoughts entering your head, and in a certain sense, you mitigate a lot of FOMO if let's say you are diversified enough, because you capture everything, and you might want to increase the allocation and all that, but that kind of like stability, right, mental stability, what I call mental stability, will allow you to actually make better decisions. Now, next, we move on to how to actually make your portfolio truly more passive with more confidence. And everyone wants their portfolio to be passive, but I can tell you, people think that their methods are passive, but actually they have a lot of doubts about whether it can really be passive or not. So confidence is a thing. Okay, there are some things that you need to actually take note of. Okay, to be truly passive, right, you don't need to think about individual securities buy, sell, and hold decisions. Okay, you don't need to think about like how many individual securities to own, whether the securities fulfill the characteristic you're looking for, and you don't have to do deep research into these securities, and failure which, if let's say you don't do deep research, but if you don't do deep research, whether your wealth will be impaired or not. So when you're trying to become a portfolio manager, right, we talk about, if let's say we move a little bit back up, right, it's like over here on the left side, right, you're trying to become a portfolio manager, you're managing these stocks, buying and selling yourself, right, you need to think about these things. And if you're thinking about these things, how passive you're in investment, you can do it, but next time as you pass on, who in your family is going to take over this? Something to think about. Okay, so you don't have to monitor your holdings. If there is a fall in your securities, right, this is something that I talked about in my interview with Provident, right, and I felt that whenever your securities fall, right, it's an opportunity to add more, or it's time to pull out because something's not right already. Okay, you need to figure out what is wrong with the company and whether the problem is actually fixable at all. And to answer these two questions, right, you need enough like understanding about what you actually own. Okay, so which will lead to your decision whether can you or should you add more to the security. This is a question about portfolio management as well as security selection, because will you be overly concentrated if you add more to this? And if you don't pull out and your decision is wrong, right, will you impair a large part of your $3 million wealth? So these are the things that you need to think about. And if you need to think about a lot of these things, right, then I don't think it fulfills the criteria of being passive enough. Okay? So sleeping better, more truly passive is about sleeping better knowing that no securities can ruin your wealth. Okay? More like, I think if I were to strictly articulate, is that no individual securities can ruin your wealth. So if you make a wrong analysis on the security, it's not going to impact your wealth so much. So whether you make a right decision, whether Meta, right, is a fixable problem. Let's say Meta platforms, when they are having those kind of issues, is a fixable problem or not a fixable problem? Do you want it to vastly impact your wealth or not? Okay, and your wealth is your family's future spending. Okay, do you wish for your family's future spending, right, to be so dependent on your securities analysis and your forecasting skills? Okay, if you are okay with that, right, then by all means, I think it's not passive. I would say it's not passive, but you can go ahead with it. And in order for it to be passive, I think that your portfolio should be like you have that self-rejuvenating mechanism. So a lot of these kind of index portfolios, index unit trust and all that, right, or these kind of like quant systematic things, right, they have this kind of rebalancing mechanism. So they are able to do that in a systematic manner, right, and without you needing to actually do it so much. Okay, so but we're not saying that there's no risk at all. The only risk that you need to consider is the systematic risk, or known as market risk lah. And these are some things to actually talk around. Okay, and in order to be truly passive and all, right, is you have less of a FOMO things because you're fully diversified, right? Like you won't have that kind of idea that like should I invest in something? If let's say I miss out on this, what will happen? So sleeping well at night is not just about, people say you should sell until your sleeping point. And it can be the case that you sell until your sleeping point, which is 100% in cash, right? But you felt that, hey, there's opportunity cost to it. You're not beating inflation. And you cannot sleep at night because you're not sure when you should be deploying all these kind of things. Okay? Now, I've said a lot already. Okay, this is probably to the end of the presentation already. And how do we tie all these things together? Okay, and the way that I look at some of these portfolios, be it these kind of strategic portfolios, whether you do it yourself, creating an equity and bond through a brokerage platform, or you're getting these kind of like strategic portfolios from some of these companies and all that, right, is that you're buying something with these four things. Sound economic drivers and strong empirical evidence of risk and return. We show this today. Okay, well diversified to capture returns and prevent what you most fear. You're taking risks, compensated risk, but there is also it has characteristics that prevent you from some things that you fear a lot of, which you might not aware of. So we flushed this one out today. And in a certain sense, this kind of investment is like relatively more passive because of its self-rejuvenating characteristics. So you can imagine it's this diagram over here. It's a bit small, but it's trying to squeeze everything in. That you will still be a portfolio manager, but a large of the efforts is actually dedicated away. You probably still need to think about, like, for that $2,000 that comes in, which fund do you add on? Do you add on to them equally, or do you add them in a very rebalancing kind of ways? And last but not least, these strategies are simple to actually craft and implement, and they're scalable with capital, because a lot of times, whether you're $4 million, $2,000, or 200K or $40 million, right? You can find people to actually implement this in with the same philosophy, right? And it's scalable. You don't have to worry about $2,000 I cannot invest because not a lot of money. You can, okay? If you have 40 million, you can also do something similar, because you have pension funds like the Norway pension funds, right? They have a very strong basis on this indexing strategy. So they are doing it. You can also do something similar, okay? But in a certain way, simple doesn't mean it's easy. A lot of things, it sounds simple, right? But as you can see today, this presentation probably is like running 1 hour, 30 minutes already. And it's simple, but you need to know some of these things, right? In order for you to be able to live with these investments better. And this is something that I hope that I have flashed out today, that you have a better understanding about this, about asset allocations, like why is the portfolios of these strategic portfolios created this way, and hopefully this is helpful. Now I want to give you some handles for those DIY investors to actually go down. Okay, these are not like my recommendations, right? But in a certain sense, right, what you can check out is some of these ETFs out there, right? Like over here, these are, you can screenshot some of these. These are Irish domiciled UCITS ETFs that is listed on the London Stock Exchange, or strategic portfolios from some of our friends at Endowus, MoneyOwl, and probably where I work in Provident. We are fee-only advisors, and you come in to invest. That's not the only reasons. You come in for holistic planning, and investments and portfolios is just one of the means to actually lead you towards your financial goals. And it's not the main thing. But if let's say you want someone to help you craft a holistic financial plan and put all these things together, like that is something to actually think about. But if you're DIY investors, these are some funds to actually check out. I'm not going to make any recommendations which one is better or not. You can invest with them through a lot of different brokerage platforms over here. So you can see some of them, they allow you, these are the brokers that allow you to invest in the London Stock Exchange itself. Okay. Now, in order to implement this, here are some handles. Okay. First, we go back to the start. You have to figure out the characteristics of your goal. Are you accumulating? Or are you deaccumulating, or you saving up for financial security? Okay, each of these goals, right, they have certain characteristics. I think like one of the main thing is whether are you spending down your money, because when you're spending down your money, there is some kind of risk involved that is very different that some portfolios are closed off to you. Okay. Then this will allow you to determine what's the equity and bond allocation. Okay. Now the next thing is set up the platforms, one of these platforms, and you want to fund a little by buying a strategic allocation. Okay. I say fund a little. Don't put at the start. Put in all your money. And why do we put in a little bit? Okay. It's to get invested. Have skin in the game. Slowly along the way to actually grow to actually understand this. Because if you're not sure about some of the things that I talk about today, it's time to actually deepen it. Okay, so in a certain sense, you can check out it. You have to continue to read deeper into it, because it's simple but not easy. Okay. But the more that you understand all these things, right, you build out your convictions. That's where you dare to actually put in more of your money. You clear up all your doubts. I hope my presentation today clear up quite a fair bit of the doubts. But you definitely have I'm sure that you have more questions about this. So these are some books. 3 to 7 is some books that I think you can go find in the library. They should be available in the library that will deepen your understanding about these things, because like you will have questions like what about the returns, like compare this to that, and all these sort of things. Like there is some things that even in this 1 hour 30 minutes conversation we have not flushed out everything, and that's where I think it's important to read something like in a book form or in a long form, right? So in order to understand every context of it. Now, one person's videos, right? I think this guy called Ben Felix, right? He actually works in PWL Capital in Canada, right? He makes a lot of these videos, right? That shows a lot of empirical evidence, and he expanded a lot on these things. And watching videos might be your means of actually trying to understand all these things, and you can check it out. But of course, like sometimes I blog on investment modes, and I write about this kind of stuff, and it's always good to actually like see what I have to say about this. Okay. With that, I think I come to the end of the presentations. You probably have some questions regarding some of these things, and please leave it inside the comments itself. And if you find that my presentation today is valuable, right, do like and subscribe. I want to see whether I have the bandwidth to actually make some of these videos. A lot of these videos originates from readers' questions that I think in writing is much more difficult to flush out, but it's also sometimes some of the conversations that we have inside the companies between the advisors, our solutions team. I work in the solutions team in Provident, which is a fee-only financial advisory firm. So as well as discussion with our investments people. But do note that this is not the views of Providence investment team, not the view of Providence Solutions team, and not the view of Provident. It is Keith's view. And how aligned is this view or not? Something for you to find out from your advisors, if let's say you're a client of Provident, to actually flush out some of these things. And with that, do enjoy the rest of your day, and look forward to the next video.